This has been a busy earnings week. So Google just reported and their numbers look really good on the surface. So let's dive a little bit deeper and see what the numbers really tell us and if the thesis still holds in holding Google shares as we do in the public account. So let's dive into the numbers, like and subscribe, and let's get into it. So let's first go through the numbers, and CNBC just reported this a few minutes ago. So let's look at some of the quick numbers so far. What we have is they beat revenue. They had 96.43 billion versus 94 billion estimated. 2 billion beat right there. That's awesome. Then their earnings per share came in at 231 versus 218, beat there. So they broke it down into their segments also, or some of their segments at least. So they have YouTube advertising revenue coming in at 9.8 billion versus 9.56 billion. No surprise there. YouTube is a beast when it comes to generating advertising revenue. Google Cloud revenue, this is interesting. They came in, they beat 13.62 billion versus 13.11 billion. And that's important to see where they're going with their cloud services and if they're still competing with Azure and AWS. And I think they're doing a great job. This number has just been keeps going up and to the right. So they're taking market share and competing well, I think, in this space. And then traffic acquisition costs, TAC, came in at 14.71 billion, which is a little higher than what is expected at 14.18 billion. But that's to be expected. They're maybe taking a little bit more aggressive approach to getting their traffic and spending a little bit more there, so the cost went up a little bit. So overall, those are the numbers that the CNBC has reported so far. Those look really amazing, and overall revenue grew 14% year over year, higher than the 10.9% expected by Wall Street. And the other thing that's super important to look at is whether they're going to keep spending their CapEx, a large portion of their CapEx towards AI. And I think this next paragraph says more about that. Alphabet is going to spend more on AI in 2025 than expected. So this might be an indication for other big tech companies where their spend is going to be, because usually they have to compete against each other. So they increase their CapEx in one, another competitor comes in, increases their CapEx in AI spend as well. So they said initially in February, they were going to spend about 75 billion in capital expenditures for 2025 and to continue expanding AI strategy. And this was already above the 58.84 billion that Wall Street expected at the time. Okay. The company raised that figure on Wednesday to $85 billion, their CapEx spend for 2025, saying that it was raising the figure due to strong and growing demand for our cloud products and services. In the immediate term, this is going to be a hit, obviously. They're going to, either generate less free cash flow because they're going to generate less free cash flow because they're going to be spending more. But over the long term, they're saying that they're seeing strong demand in their AI products and services, and they want to continue pushing that envelope forward, increasing the spend, keep being on the leading edge of AI strategy. And I think I saw a video on CNBC from some analysts saying that they might be the leader in AI at the moment with their AI capabilities. So we can get into that in a little bit, but this is overall, as a long-term investor, this is a great sign because they're really leaning into their AI strategy and providing the resources for their teams to implement that AI strategy and vision. So honestly, I'm happy about this. I want them to keep up with competitors like Amazon and Microsoft and Meta and other companies like that are also pushing their AI capex to new limits, to new higher limits. So I like seeing that. Alphabet's search and advertising units still showed growth despite artificial intelligence competition heating up. That's great news. The company's search unit brought in 54.119 billion, during the quarter, and its advertising revenue grew to 71.34 billion, up from 64.61 billion the year prior. So, wow. Okay. So the big story almost all year, all of last year, and for the foreseeable past was that Google's advertising revenue was going to get hit because all this competition from ChatGPT and all these other AI search services, really. So here you see that their advertising revenue, even if the search percentage may be hit or staying the same, we'll have to see, but their advertising revenue grew to 71.34 billion, up from 64.61 billion the year prior. Google's YouTube advertising revenue came in at 9.79 billion, higher than Wall Street expected. So yeah, this is really good on Google side. This is like probably an A. Like just looking at these numbers, it's an A plus in an earnings report. This is what you want to see. You want to see beats on all of these fronts. You want to see them addressing the big, critiques of their business, which is search advertising first and foremost. They're growing that revenue way more than year over year. You can see that their YouTube revenue, the other major revenue generators, are beating and increasing their revenue generation. YouTube, cloud services, and they're keeping their TAC pretty in line. It's not too much higher for that much increase in all the other advertising revenues and cloud revenues and service revenues. So I just wanted to discuss a little bit more about some new updates that came out because it was a breaking story. They added more to the earnings report release. So they said that other bets segment has reported a loss of 1.25 billion, up from 1.13 billion a year ago. So they're adding more, investing more in other bets. But if you just take Waymo, for example, Waymo is going to be the winner, most likely, in my opinion, of the self-driving car situation. And they're going to get that market. They're already successfully having self-driving cars in service in several locations in the United States, and it's really low accident percentages, and it's rolling out so securely and safely that I think they are way ahead of any other competitor in that space. So yes, they are losing money right now, 1.25 billion, up from 1.13 billion a year ago. But I think over the long term, once Waymo starts really ramping up and scaling up, and Google has the money to do that. They're not a startup. They're generating tens of billions of dollars in free cash flow, and they're able to increase their spend from 75 billion to 85 billion in capex for AI. At the same time, they're losing 1.25 billion from other bets. So they're able to take this loss for as long as it takes to get this profitable. And based on how successfully it's being marketed and rolled out, that time is coming up sooner than we think, I believe, as investors and analysts of this company. So when this does come out, I think it's going to be the winner. At least Waymo will be the winner in the self-driving space. AI overviews. The AI's Google search that they've rolled out to summarize search results now has more than 2 billion monthly users across more than 200 countries and territories. So yeah, they really addressed the search issue and tackled it head on with AI. They used AI to tackle the AI search problem, which is kind of funny. But the Gemini app, which has the company's AI chatbot, now has more than 450 million monthly active users. Those are the similar numbers to ChatGPT, I believe. So on par with ChatGPT, even though they started way earlier than Google in that space. Total operating expenses increased 20% to 26.1 billion. The biggest driver of growth was expenses for legal and other matters due in part to the $1.4 billion charge related to a settlement. So those are like one-time things where, you know, they get charged for and settle a legal case, and then, but those things they won't be ongoing. They won't be 1.4 billion charged here and then next quarter. It'll just be one-time charge, and however many there are, that's how many that will get charged. But their growth and their segments and their services will continue increasing in revenue generation. So overall, they're doing better, I would say. They'll continue doing better and better. Here's the video that I was referring to earlier where the analyst says that Google may be leading in their AI abilities with their AI services. So let's take a look at that.
Big tech earnings kick off tomorrow with Google and Tesla both set to report. Joining us right now is Ray Wang. He's Constellation Research founder and chairman. And Ray, first of all, thanks for being here. We're trying to figure out what to expect from the Mag 7. This is going to be our first look at some of those numbers. What are your expectations overall?
Well, overall, the Mag 7 are going to operate differently. We have the folks that are completely AI-enabled. We have the folks with China risk. You have to factor those two things in place. So on the Google side, they don't have the China risk, but the question is AI going to crush the search and ad business, and is Google Cloud Services going to continue to grow? The short answer is we're actually seeing a lot of improvements on the Google side in terms of AI. We actually think they might be in the lead in terms of their AI capability, but the question is how are they commercializing on the AI side? But so far, what we've noticed is services continuing, the cloud services and the Google search side and the ad side are probably going to continue in like 8 to 10% growth, and on the Google Cloud side in the high 20s.
Google's stock is flat for the year to date. All those questions that you brought up have kind of played out in investors' mind. Where do you come down on this? Is this a good time to jump in? Do you believe it's going to?
That's a little misleading for her to say that it's been flat year over year. I mean, with the numbers, yes. 1 year ago, it was probably the same price. But since that time, it's dropped to close to like 150 and then come back up all that way to 191. So, I mean, if you were looking at it between those two timeframes, it would have been a huge difference. So keep going with this.
To win on the AI front?
I actually think it's going to be one of the three winners in AI, and actually it is a good time to go in. If you look at that P ratio versus everyone else, the overhang is really coming from antitrust and this perception that they're behind in AI. But when we talk to developers, when we talk to system integrators, I was actually in India last week doing that, they all recognize that Google is ahead. In fact, Google is ahead of Microsoft on the AI front in terms of the advancements, but they might be behind on the big LLMs that are getting a lot of the money and a lot of the talent. And
explain how people think they are ahead of Microsoft, or the people you spoke with in India.
Because the technology behind what's going on from VO3, from Gemini, it's actually being used by developers. It's actually being used on the coding side. It's actually being used to build products. We have a client that basically, with 10 people, beat out another.
A funny story is I'm actually using Gemini to build out the stock valuation software that I will show you to evaluate Google in a few minutes. So that's kind of funny, but let's keep going.
Client with 110 people to do the same job in half the time and half the price. Wow. Using Google Gemini.
And you've got a price target, I think, of $210 for,
yes,
for Google, for Alphabet. So you're a big believer here. What about Tesla? Because it is one that if you look over the last year, it's up 30.
Yeah, so based on that, it seems like I agree with a lot of what that analyst said. I think they are leading in many ways, if not the leader in AI services. Their Gemini services, I've been using Gemini, the pro version of Gemini, for I would say a few weeks now, and it's really good. It's really good at building and really taking your input and interpreting it in the right way to create what you need. So I've been using it today, like just to build the software, to make more enhancements, to make updates, and it's been really easy to get that going. But I say all that to say that I think Google is in a great spot. Looking at their initial numbers, it looks great. So let's move on to a stock valuation to see where it is right now. These numbers are probably not going to be reflected in the software just as of yet. I think it'll take another day or two. But let's go through the stock valuation software to see what the valuation stands just prior to this earnings report. Okay, so let's go to beardedinvestor.com and go hit up the software that I'm building. I've made so many updates. You guys will see this in this valuation, but still not ready for prime time. I'm trying to make it as valuable as possible for you guys. So you'll see all the updates and enhancements I've done using Gemini, like I said. But yeah, let's go here. So I updated the website homepage as well to kind of be the landing page for the stock software. But yeah, so when you do sign up as a member, you'll have this bar at the top of the beardedinvestor.com homepage, and all other pages that you go into. If you go into educational courses or are reading a blog content, you'll always have access to this if you're a member. And so if you want to look at Google, you can pull up Google and you can see how I've changed it, at least this company overview section that you see right now. So here, let's look, current price 191.5, even after hours, I think it's up a little bit. Let me see. Yeah, it's up a little bit after hours, 193.17. That keeps changing. But it ended the day at 191.5. It's risen so much recently. But yeah, I was buying this at 160, 150s. That was a good time to buy it. Shares outstanding. This is just for Google. I just pulled up the Class C shares. There's also Google L, which is the Class A shares, I believe. So those combined have like a 12 point something billion shares outstanding. I added insider ownership, institution ownership, and the ex-dividend date. So I want to get as much value in this first initial snapshot as possible. And then I added company details, what the exchange it's on, trading on, technology sector, industry, address, SEC filings. So this is really cool because I have the CIK number. I was able to put in a link to the CIK, SEC filing. So even if you don't want to use my software, you can become a member and you can easily access the 10Ks, the 10Qs that the company is the official 10Ks and 10Qs that the company is reporting to the SEC. So you can get all the numbers one way or another. You will have the value if you become a member with beardedinvestor.com. So if you want to see that opens up a new tab and you have Google all lined up here, 10K, 10Qs, and you'll see all the new ones. So as this gets populated with the new report that they just did, the new earnings report, all those values get interpreted by this software that I'm providing for you, and you'll be able to evaluate your stocks and go from there, make investment decisions from there. So that's a really cool new addition that I liked and I wanted to show you guys. But let's go through the new additions on the software. So I have now separated performance into data trends and visual trends. So let's look at Google. So this is really cool because you'll have a bar chart that's integrated and combined for each year. So you can see that Google has been increasing steadily in all their numbers, really. Free cash flow to share, book value to share, net profit margin, return on equity has been really good. 20s to 30s is really good return on equity and return on capital. And then shareholder equity is just continually rising. So that's great to see. But if you're a more visual person, I've introduced 20 years of past data in several different key metrics and several different filters to allow you to see and visualize what you're looking for. So here I have all charts, but you could be looking for growth, which is the revenue. And you can see how revenue is just basically a straight parabolic line up. Profitability, you have net income, EBITDA, free cash flow, which is really important. They did 72.76 billion in 2024, which is really good. EPS and expenses, which is broken down into selling, general and administrative, research development, and interest expense. And that's all looking good for them. Financial health looking good. More cash and cash equivalents than debt, total debt. Dividends and shares outstanding, really good. They've been cutting back their shares since, about 2017, 2018, that time. And they've been just cutting, doing share buybacks, as they should, because their stock price has been not keeping up with, and it's probably going to turn at any point now, and has been turning, but it hasn't been keeping up with Amazon and Microsoft and all these other companies that do not have the same degree of headwinds in terms of regulation and government oversight. All of that gets baked in and is a headwind for Google, and has been for many years now. So you can see that they should be buying back these shares while their company is still cheap, because all their other metrics are growing. Their growth, profitability, all going up. Look at this going straight up. So at some point they're going to get re-rated, and that may have already started happening. But as you heard the analyst, his price target is 210. It's just going to get it. Eventually the fundamentals win out over, the news and regulations and all that stuff. As long as there's an end to those things, there will be, the fundamentals of the company will always shine through, as long as they're growing like this. And then in the valuation section, I made major updates here, and now all of these are clickable. And I've introduced trailing PE and forward PE. So now you can really see, trailing PE is great. Trailing 12-month is great, 21.4x. Do forward PE to see the next 12 months, and the PE dropped to 20x. And the PEG and PEGI ratios also dropped because they're based on the PE ratio. So now they went down as well. And so you can see that if you click on the PEG and PEGI ratios, you can bring up the PEG-PEGI ratio calculator. And when I switch this on, the PEG and PEGI ratios went down, which means they're becoming more attractive because the PE is getting lower with this new forward PE, which is lower than the current trailing PE. And all the same functionality that I shared with you the last video is the same. So you can still change these numbers as you want to, and do your analysis or your own assumptions based on the stock price, earnings per share, estimated earnings growth, estimated dividend yield. You can change all these numbers and see what happens to the PEG and PEGI ratios. Again, PEG and PEGI, anything between 0 and 1 is a undervalued stock, potentially undervalued stock. Anything around 1 is fairly valued, and anything above 1 is overvalued by these metrics alone. So it's not the only metrics, and there's also DCF modeling and other metrics you can use to evaluate stocks, many other ways. But by this one metric alone, that's how you would quickly see if a company is undervalued, fairly valued, or overvalued. So I thought that was cool that you can now do this, and I added this functionality where you can switch from trailing PE to forward PE. And then obviously, if you don't have a mature profit generating company, you can use PS, the price to sales ratio, or the price to book ratio. The price to book ratio is more for financials and industrials, because they have more assets and things on their books that mature growth or tech companies don't really have. So there's other ways to evaluate things relatively. And then I also added EV to revenue and EV to EBITDA, just for reference, and they're all clickable and they all show up in this interactive chart. So I thought that was really cool, and Google looks amazing. You hardly ever get a big tech company, multi-trillion-dollar tech company, for a PE ratio, for a PE ratio of 20. That's much better than Amazon, much better than Microsoft, and they have the numbers and revenue to back that up. Like, sometimes if PE is dropping, if the forward PE is dropping, it means that their analysts are expecting that growth isn't happening. That's not the case with this company. As you can see, that their growth is very impressive and will be continuing they're showing great metrics for all of these great numbers for all of these metrics. And then finally, I redid the whole fair value analysis, and now we have a nested donut chart, and it's using the same calculations and assumptions that I built into this software, but it shows it in a more visually compelling way. So this is all animated, but I just moved down to this section already. And you'll see that this software will show you the fair value versus the current price. And here it's estimating a fair value for Google of $296.9, which is higher than what the analyst estimated. But this is the discounted cash flow model. And it's giving a 55.1% discount to the current price, this fair value. So current price on the outside, current fair value on the inside, and it'll tell you at an instant here with this cash flow to equity for future years discounted to the present day. This software tells you exactly whether at a glance the number, the fair value number, the percentage discount, and whether it's undervalued or overvalued very quickly, or fair valued very quickly. So it's all color coded, and if this was overvalued, you would see this turn red, and it would say, you know, such and such percentage premium, because you'd be paying a premium rather than getting a discount. And then finally, I just want to say that all of these assumptions and calculations can be found in this data modal that I added here, and you can see that it has like everything that you need to understand this model. And I will be going forward in the future and doing courses, video courses on how to understand each step of this type of DCF modeling, because it can be quite complex, but after you learned the principles and the concepts behind these things, you will understand why it makes sense and what everything means. So there's a lot of terminology that you need to understand. There's a lot of concepts. There's a lot of formulas. But once you understand all that, and hopefully you can understand that through my courses and my educational courses and everything that I've written and done on beardedinvestor.com, and maybe even through this software that you hopefully get a membership to, this will show you exactly how we came to that $296 price target. So it's all laid out here, and it's really good. But as far as Google goes, it's great undervalued stock, in my opinion. And if you want to look at even the relative key metrics, this is the intrinsic value. This is the relative key metrics, which you would use to evaluate it against other companies in the same industry. So PE ratio, you can compare Google's PE ratio to Amazon's PE ratio to Microsoft PE ratio, because they're all in the same similar industry, at least with some of their services. Amazon is a little bit of a jack of all trades, but let's say Microsoft and Google, you could compare pretty easily. Microsoft, Google, Meta, you could compare pretty easily with their PE ratios, and it would be pretty accurate, that comparison, like apples to apples. So that's it, guys, and that's what I've been working on for these past few weeks, and I'm glad I was able to do a analysis of Google at the current time and go through their initial numbers from their earnings report for Q2, and that's what I wanted to show you guys today. But numbers look great. I love Google right now, and I'm excited to be a shareholder. I'm not selling anything in Google, keeping it in the public account. It has gone up. More than I wanted it to. Obviously, as a value investor, I'm always trying to get the best price, best value for a company that I can. So if it does drop from here for some reason, and the PE ratio, the PEG and PEGI ratios can come closer to 1, I might add some more shares. I already have 200 shares in the public account, as you saw in one of the previous videos. So I would be adding if it got closer to that. But the fair value seems like it's a very good deal right now. So thanks guys for joining me on this long long video about Google and their value and their Q2 earnings report. If you want another video on the in-depth numbers, I just took the quick numbers off of that CNBC report. But if you want to see an in-depth look at their 10K filing when it's available, or sorry, their 10Q filing when it's available, let me know in the comments below, and I will do another video on that and go through line by line and really dive into the details. But I wanted to get this video out quick for you guys, just to tell you the news, tell you the most important numbers and most important concepts for Google, as I've already talked about in previous videos. So thank you guys, like and subscribe, and I'll see you guys in the next one.